welcome to the Growth Engine Fundamentals video series. And in this episode, we're going to be speaking all about finance. Now, if you think about finance, it's in every aspect of your business, and without it, your business doesn't run. See it very much like the blood that runs through the veins. I'm often asked, what role does the management team play, and what role does the finance play, and a whole host of other questions. And ultimately, here's a great little way and a little sort of analogy that I like to think about it. Whilst the management team is the heartbeat of the business, finance is the blood that runs through the veins. And in this sort of video series, we're going to be speaking in each stage about the growth engine fundamentals, just to set the stage exactly what we mean, and ultimately that really falls back into two things that are very closely related, which are team alignment and making sure that right from the top, the business adopts the inbound methodology throughout the entire business model, not just the marketing area. And we'll then move into the overview of Growth Engine Finance, and we're going to be touching on raising capital, employing capital, managing capital, and distributing capital. And the term capital is finance or money employed, and we'll talk about that. So that could equally say raising finance, employing finance, managing finance, and distributing finance. But for this video series, we're going to call it capital. So without further ado, let's move forward. And I said we'd start by sort of setting what I call the fundamentals. And when you're talking about growth engines, and especially around the inbound methodology, we use the inbound flywheel, which is broken up into three specific areas of attract, engage, and delight. And it puts the client at the center of everything that you do. So if you're going to become an inbound business, then the client has to be at the center of everything you do. And don't fall into the trap that thinking that the attract phase is just related to marketing, and the engage phase is where your sales team take over, and then the delight phase is where your customer service team manage and look after them, the clients once they've become customers and purchased. That's not true. The attract, engage, and delight phase is at every single point. So that applies in marketing, it applies in sales, it applies in customer service. So when we talk about growth engine fundamentals, we're going to be making references to the flywheel and ensuring that the client's at the center of everything that we do. Now, it doesn't really matter what type of business that you are. They're really outside of what I call corporate governance and the law and the legislation. So outside of that, which I've left out of this presentation here, that there is only 5 segments or areas of a business. And that doesn't matter if you're online e-commerce, you're an elongated long sale, complicated sales process, you're in B2B, B2C, H to H, doesn't really matter. The 5 really are applicable, and whatever you do within your business is really going to fall into one of these 5 buckets. So let's just take a recap of these. The 5 buckets or 5 areas are finance, operations, people, marketing, and sales. So, you might be sat there thinking, well, where does my manufacturing team or my customer service team fit, or, my customer service team who are maybe on refunds, or, the ones who are out there doing trade shows and, and things like that. So I'll cover that on the next slide. But I just really wanted to recap. Growth engine fundamentals put the client at the center of everything that you do. And even when they're just becoming prospects before they're even clients, attract, engage, delight is applicable throughout the marketing, the sales, the customer service, and every single touch point that you have. So moving this next slide forward, you can see here at the bottom, finance, operations, and people really span out into what we call inbound client services. The marketing is inbound marketing, and the sales is inbound sales. And I just really want to break down the point that I touched on earlier. If you think about it, the finance is what funds and fuels the business. The people is what, make it move, the actual execution of it. And that will sort of spread, people will spread into finance, like your purchase ledger clerks and finance directors. People spread it to marketing, the marketeers, and obviously salespeople, business development reps, sales managers, field representation, whatever you have type of titles there. But people always drop into operations. And the way I see operations is everything from the products that you manufacture, the distribution channels that you get your goods to market, whether that's your transport division, your courier division, your customer service team, your research and development team. So that's really where I bundle operations in. And ultimately, if you think about it from an inbound marketing point of view, that's bringing prospects who eventually become customers through inbound sales. And then inbound client services is really the fulfillment or the production or delivering what you've sold. So again, it's just getting familiar with that terminology, right out of the gate. And ultimately, if you think about it from that point of view, if it's not marketing to bring people to the business and nurture it and educate them through a process, or it's not sales that is actually engaging and helping people to buy, then ultimately it's going to fall into fulfillment that we class as inbound client services. So let's get a little bit of more of a highline overview on growth engine fundamentals of finance. So in the first section, we're going to be speaking around raising capital. And for you guys out there who want to leave any questions on the blogs, I'm more than happy if you want to leave a comment below. We can expand on this, or if you want to send a private message, maybe you've got some sensitive information that maybe you don't want to put in the public blog comments, you can either connect with me on LinkedIn, Mike Midgley, you'll see that there as part of the Success Hub. If you want to use hashtag growth engine on Twitter, we can then direct message you on there and keep that private. And at the end of this video, we'll give you an option to set up a 15-minute no obligation growth engine initial conversation if you want to have a one-to-one conversation. So what we're trying to cover here is about raising capital. And for businesses who are early stage or even established businesses who maybe want to go to the next level or even exit, these sort of points are really highline, and I'm just going to touch on them. So I must stress these are not sort of student level bachelor degree explanations, and they are touching the outer circle. Like with finance and any other area of business, you can go down 3, 5, 8 levels and have really granular, detailed conversations. For the purpose of these exploratory videos, this is not it. This is an overview. So when we talk about shareholders' funds, we're really talking about the capital and the equity that's employed and the people who actually own the business. That's how I'm describing shareholders' funds. So if you're an owner-driver, you're a 1 or 2 director team, you're going to have some type of stakeholding or shareholding and shareholders' funds. When we talk about traditional borrowings, now that could be a private loan, like a director's loan that you've put in, but more commonly associated with what we call high street bank lending, overdrafts, investment, working capital loans, bank loans, and overdrafts. I haven't got on here invoice financing or invoice discount, but to a degree that would also fall into traditional borrowings. A business has got a need for cash, it sells goods out over a period of time, it's waiting to get paid because it has to provide credit terms. So it's either relying on cash in the bank, it's relying on an overdraft, or maybe a loan to keep the business liquid until those invoices get due for payment. Maybe it's accelerating those invoices through invoice financing or invoices. So that's what we mean about traditional borrowings. Angel investment. So if you've got a pretty unique idea, there is a lot of people, I'm one of them, I do certain angel investment in tech firms and fintech firms and sort of unique sort of disruptor models. I'm a private individual, although I'm a business person of multiple interests. And there's a lot of angel investors out there who are not associated to any banks that've been successful in business, or maybe they're just high net worth individuals, HNW individuals, and maybe they like to experiment and put a proportion of their capital into businesses and back the early stage directors or partners. Sometimes that's seed capital before there's even a minimum viable product. Other times it's where there's a borderline outline minimum viable product, and they need that extra money to go to the next stage before they move into things like venture or growth capital. So, angel investment is usually one person or a panel of people who are using their own money to sort of help a company in certain stages. Venture capital, like angel investment, is usually brought in the earlier stages of a business's lifestyle. Very high risk. It's not uncommon that, if we were using a typical example of 10 investments, the venture capital company may rely on 2 to hit a home run, and the other 8, some would sort of break even, and, a few would lose money. So venture capital is usually higher risk and deployed to really make the company grow and get to the next level. And it can be expensive money, but if it allows you to get your product to market, is that a 30 yield or something like that? They get different models, different business, different distribution. I've said more ones, but it's not uncommon for that case. Does it ever really end up being that? Maybe not. As a tombstone deal, it might be a 5 or an 8 or a 10 sort of return on the initial venture capital invested. But again, all subjective to markets, models, how fast, what cycle, the market that you're entering, how good the management team, how strong the contracts are. But that's venture capital, and highly recommended if you've got a business that can grow. It's more established. It's got contracts, it's got products. It's already generating revenue. You really want to turbocharge it. Venture capital is a great way to bring that extra in, fund your business infrastructure, and move it forward at a rapid rate. Growth capital, don't get sort of confused between growth capital and private equity, or growth capital and venture capital. Growth capital usually comes in at a later stage to move the business through to an IPO, an initial public offering. It's not usually brought in right at the beginning, it's more at the back end. And I'm going to do, as I said, a deep dive on each one of these series later on, so you might be able to check those out on the blog, more deeper dives on the YouTube channel. If you head over and check Growth Engine channel or Growth Engine blog, you'll find that. So private equity, really, are they already public or right at the end of going public? It's a bigger deal value. These guys are, buying out the venture capitalists, refinancing, and then really getting the business to the next level. Again, we'll do a deeper dive on that. And a lot bigger deals, tens of millions, even 10 billions, those type of people will do. And usually the private equity people may own 90 or even 100% of the business model. Whereas in growth capital, especially if they're taking through an IPO, they're going to own a big stake of that, but there's still going to be some sort of shareholder value there from original founders or directors or venture capitalists. And venture capital, I didn't cover that earlier, they might take 10 or 20 or 30% of the business. If you're watching this and saying, hey, Mike said that, it depends on the risk, depends on the market. They may take more, they may take less in return for the capital that they employ. But ultimately, venture and growth capital can have some kind of stakeholder, original ownership. Private equity can be more or less 100%, and in a lot bigger deals. And it wouldn't be discussing capital or raising capital if we didn't touch on security. And at every stage, security is going to be required. And it depends on, if you are the existing founding director, you might, you're using your own savings or capital that you've saved up, and you may be remortgaging the house to put in. So, there may be indirect security on your mortgage or anything like that on your property. Traditional borrowings, not uncommon for banks to want personal guarantees from directors, certainly majority shareholders, same for invoice factoring, discount factoring. They may not take security over the director's guarantee, but they might want security over the book or the invoices that they're factoring or discounting down. Angel investment is certainly going to require some form of security in the form of stakeholder shares. So they're going to take some shareholding in your business, and that's the security that they've got some form of input into your business, accountability. Venture capital would just do the same, growth capital would do the same, private capital would do the same. So security is a very broad range from personal security, personal assets such as debentures over properties, security against book debt or the sales line, the revenue line of the business, security over the shares, and that could come in preference shares, where they get the first exit value on any sale of shares. So security is going to be there. If you are looking at raising capital and you don't have any security, or you're not prepared to give any security, i.e. in the form of a personal guarantee or debenture, then I think you are going to struggle in today's market, and you probably have always struggled. It's what I call a straw man. You're trying to raise capital against nothing, and turn it around 180 degrees. If somebody's asking you whether it's for £10,000 or £100,000 or £1 million or anywhere in between, or even more or less, would you lend them that money without some form of tangible security? If you're being absolutely honest with yourself, the answer is probably no. So that wraps up raising capital. It's just an overview, a highline level. And as I say, if you've got any questions on raising capital, leave us a message on the blog below. If you want to use our preferred channels on Twitter, use the hashtag growth engine, and we will get those answered for you. Alternatively, if you want to connect with me on LinkedIn and send me a private message, I'll be more than happy to assist you.